Hey YouTube, Jason here with Day Trading Fearless. Welcome back to my channel. If you're new, welcome. Make sure you guys hit the like button and also subscribe. And all these option videos are sponsored by myself. So these are the weekly trade zones for the S&P Emini futures. $50 one-time payment for a lifetime subscription. I've been doing these for about 7 or 8 years now. And every weekend I send you all these trade levels. Again, $50 only. Go to daytradingfearless.com or click the link down below in the description. And also make sure you check out my Patreon page at patreon.com/daytradingfearless to follow along with my trading portfolio. So, with that being said, let's jump into the option video course, and I hope you guys enjoy it. And thank you for watching. In today's video, we're going to talk about protective calls, okay? What a protective call is and how to trade it. So, your market opinion is going to be bearish, okay, on a doing a protective call. A protective call is a position where you are short the stock and long the calls. This is a position that you think the stock will head lower, so because you're short the stock, but are protected if you are wrong and will be hedged by the long calls. So this is kind of a hedged position. So the example would be you short 100 shares of XYZ stock at $20. You then buy one XYZ October 20 call for $1 premium. Your max loss is the dollar of premium that you pay, right? And your max profit is $19, right? Because the stock, if you're short and it goes from 20 to 0, that's $2,000. But remember, you had to pay the $1 of premium for the call. The break even is if the stock closes at $19, right? And if the stock is above 20, okay, then you'll see what happens there in this example, right? So stock XYZ is at $20 and you will short 100 shares. You also will buy one October 20 strike call for $1. Your break even is $19 because you paid $1 for the call. The call you bought acts as insurance because if the stock runs to $25, then you have lost $5 on the short stocks. But the October 20 call that you bought for $1 has made $4 after that premium, right? Because you've paid the $1 to have the right to buy the stock at $20. This type of trade also gives you a limited risk of $1 and the maximum profit of $19 if the stock went to 0. So as you could see, protective calls are actually a really good strategy. So let's go back to our Viacom, right? So I could sit here and short Viacom at 40, we'll just say that number is 42, okay? We could come over here and sell the 42 calls for 260, okay? Or sorry, buy the 42 calls for 270, okay? Well, we know that we're from the $42 here plus the 270, the most we could lose is $270 if the stock went to $50, right? Because we're now hedged by this. But just remember, if we go short, we need the stock to drop at least $2.70 at expiration to just get to break even. But anything below that is money in the bank. So that's how a protective call works. And that's it for this video. And we'll talk to you on the next one.